Hello and welcome to today's webinar. My name is Kurt Shoemaker and I'm the Policy Director for State Paid Family and Medical Leave for the National Payroll Reporting Consortium. We've partnered with the Minnesota Department of Employment and Economic Development to provide TPAs and employers an opportunity to learn more about Minnesota's paid family and medical leave program and to provide answers to some frequently asked questions. Our host for today's webinar is Corinne Horowitz from the Minnesota Department of Employment and Economic Development, who will tell us a little more about today's agenda and introduce our speaker for today. So I'm going to hand it off to Corinne, who will take us through the rest of the program.
Well, hi, everyone, and thanks again for being here. As Kurt said, my name is Corinne, and I'll be facilitating today's webinar. We're thrilled that so many of you can join us today. We have about 229 folks here and counting online with us right now. During today's presentation, we'll do a quick overview of the paid leave program, talk about employer roles and responsibilities, and walk through how to create a paid leave employer account. We'll also reserve the remaining time to answer your questions. We have a lot of information on the website, info.paidleave.mn.gov, including frequently asked questions and an employer toolkit, which we continually update. I'll also note that following today's webinar, the slides will be posted to the paid leave website on the public events page under the About Us tab. Today's webinar will be recorded for training purposes. Should we decide at a later date to make the recording public, we'll post the link to our website. We also send out regular email updates about paid leave. If you haven't already, you can subscribe to the newsletter on the website as well. My team members, she is putting all the links I just mentioned in the chat. All right, so today we're joined by Greg Norfleet, the Director of Minnesota Paid Leave. We'll start with a 45-minute presentation from Greg, followed by the Q&A session. For the Q&A session, you can submit your questions to us by using the chat button. You can find the chat button at the top of your screen. It's a purple speech bubble with a question mark on it. There are two tabs in the chat, the Featured tab and the My Questions tab. Check the Featured tab to see announcements from our team and links that Greg mentions throughout the presentation. Use the Questions tab to ask a question at any time during the presentation. Only you and the webinar team can see your question. Likewise, other attendees will only see their questions. Our team behind the scenes will be reviewing and moderating the questions for the Q&A session. With such a big audience, we won't get to all the questions. Please ask anyways. We keep track of all the questions and use them to inform our outreach and update the FAQs on the website. If we don't get to your question, the Paid Leave Contact Center is ready to help you at any time. You can reach out to them through the form on the website, info.paidleave.mn.gov, or by calling 651-556-7777, Monday through Friday, 8:30 to 4 p.m. All right, that's enough from me. It's time for the presentation. Turning it to you, Greg.
Thanks so much, Corinne, and thank you to the MPRC for helping set this up today. We do want to just, recognize National Payroll Reporters Consortium has been such amazing partners throughout the implementation effort. And to embarrass our host, Kurt, a little bit, when you talk to other paid leave directors across the country, his name is one of the people that you have to know because of his expertise in the program. So we're really grateful to all the support that the consortium has provided to the division and being able to set up events just like this to get the word out about how employers can prepare for paid leave. We're now 111 days away from going live with paid leave for the people of Minnesota. And today, our presentation's chiefly focused on what employers can do today to be ready for that date. So without further ado, I'm going to just jump in and start talking through what this program is all about. So when we talk about paid leave, this first portion of the presentation is really just to get you familiar with the basics of the program, when your employees may require taking paid leave, who's covered under the law, and what benefits and job protections are available under the paid leave program. So to jump into the history of the law, it was enacted in the 2023 legislative session and updated each successive session as well. And we are going live on January 1st, 2026. On January 1st, 2026, this will create a paid family and medical leave insurance program, and that will provide both job protections and benefit payments paid directly by the state to individuals who need time off to care for themselves or for their loved ones. This program, much like private insurance, is funded by premiums. Those premiums will be split between an employee and an employer contribution. And when somebody goes out on leave, unlike programs like ESST, these benefit payments will be paid directly by the state to Minnesotans while they are out on leave. This is our program on a page. When you hear paid leave, often called paid family and medical leave, we talk about two lines of coverage: medical leave and family leave. Medical leave is exactly what it sounds like. It's time off for yourself to recover from a serious healthcare condition. When a serious healthcare condition under our law is something that is going to keep you out of work for an appreciable amount of time. In fact, in order to qualify as a serious healthcare condition, the underlying qualifying event needs to last at least 7 days, and in all cases will need to be certified by a healthcare provider or a designated professional working in their field of practice. So medical leave is time to care for yourself. Family leave is a little bit broader. It includes time to welcome a new child into your home, whether that's through birth, foster care, or adoption. Time to care for a family member with their own serious healthcare condition, as well as providing support to members of our military during an active duty deployment, whether domestically or abroad, and providing support to survivors of domestic violence and sexual assault. The program offers up to 12 weeks of medical leave or up to 12 weeks of family leave within a benefit year. A benefit year is a period of 52 weeks that starts on the first day that you are absent from work. Now, you can take up to 12 weeks of medical leave or up to 12 weeks of family leave during that 52-week period, but there are situations where a person may qualify for both medical and family leave. The most common example of this is a parent that gives birth. In that scenario, that Minnesotan may need time to recover from the pregnancy, either prenatal or postnatal care, where they would be taking medical leave. They would then still be entitled to time to bond with their new child, which would fall under bonding leave or under family leave. In those situations, although you can take up to 12 weeks of medical leave or up to 12 weeks of family leave in a benefit year, you'd be eligible for up to 20 weeks in that period if you're taking both. Our program is extremely broad in its coverage. It includes nearly all working Minnesotans. That includes whether you're a full-time or a part-time worker. If you're only a temporary worker that's providing services for a month, you could still be covered under our program. Even folks that are excluded from other state and federal programs like FMLA or the Unemployment Insurance Program or ESST are nevertheless required to participate in the paid leave program. A few of these to highlight for our audience today are owner officers who draw a salary, even as owner officers of an S Corp. If they draw a salary, they are required to, those wages are subject to paid leave. Additionally, employees of religious organizations and all agriculture workers and employed family members, although they're not required to participate in the unemployment insurance program, they are required to participate in paid leave. Additionally, folks that are exempted from earned sick and safe time, like first responders, are also, there's no similar exclusion under the paid leave program, and so they would be required to participate as well. So if you're providing services in the state of Minnesota, it's a pretty good bet that you're covered by the paid leave program. There are very limited exceptions. First, independent contractors, self-employed individuals, and travel nations are by default not required to participate in the paid leave program. However, these groups will be able to opt into coverage. On the other side, federal government employees and railroad employees are not ever covered by the paid leave program. And that's because we are a fully state-funded program, and so employees of the federal government cannot be covered under the paid leave program. There's also a small, very narrow exclusion for certain seasonal hospitality employees in the statute. This is an extremely narrow exclusion that only applies to businesses that are seasonal in nature, that are in the hospitality industry, and for employees that work 150 days or less during the calendar year. Individuals and employees that are in that situation will soon be able to designate those employees as not covered under the paid leave program. But as I said, all three of those criteria need to be fulfilled, so it is a very narrow exclusion. One topic that comes up pretty frequently outside of what types of workers are covered under the paid leave program is what happens if I have employees that work in multiple states. This gets into a concept called localization under our law. Paid leave covers Minnesota employees, which means that your work needs to be localized to the state of Minnesota. So the way to make this calculation is looking at where the majority of your work happens. If you work 50% or more of your time in the state of Minnesota, your work is localized to Minnesota and you would be covered under the paid leave program. If your work takes you where you're spending 50% or more of your time in a different state, you will not be covered by the paid leave program, even if the employer themselves is in the state of Minnesota. So it really matters where your work is physically happening. In the case of remote work, that means that if you are spending, say, 3 days a week in Stillwater, Minnesota, and then going across the river into Wisconsin 2 days a week, you would be covered by the law. But the inverse of that situation, where you're spending 3 days a week in Wisconsin and 2 days a week in Minnesota, you would not be covered under the paid leave law because your work is localized to the state where you spend the majority of your time. Now, that takes care of the majority of cases. If you spend most of your time in one state, you know where your work is localized. But for employees that spend time in multiple states, then in no state do they spend more than 50% of their time, then it might matter where you live. So this is often called the traveling salesman situation, where somebody spends 1/3 of their time in Wisconsin, 1/3 of their time in Iowa, and 1/3 of their time in Minnesota. If you're in that situation, then you would be covered under the paid leave law only if you live in Minnesota. If you lived in any one of those other states, you would not be covered by the paid leave law. So a few scenarios just to kind of check your understanding on this. If your business is located in Minnesota, but some of your employees live in Wisconsin, that isn't going to be determinative as to whether or not those folks are covered by paid leave. Even though your business is in Minnesota, it depends where your employees are physically performing their work. So in this case, you would need to ask the employer, where are your employees physically working? The second scenario, even if you have a business that's located in Wisconsin, but some of your employees are working remotely in Minnesota, those employees may be covered by the paid leave law if they're spending 50% or more of their time in the state of Minnesota. And then in that last situation where you work in multiple states, but you live in Minnesota, the first question that you should ask is, are you spending more than 50% of your time in any one of those states? If so, your work is localized to that state. If not, you need to ask where that employee lives. If they live in Minnesota, they would be covered under the law. So that's who's covered by the program. Let's talk about what it means to be covered by the program. Like we said, the paid leave program is a social insurance program that provides partial wage replacements and job protections. When we talk about partial wage replacements, this are payments made directly by the state to individuals while they're out on a qualified leave. These are really there to make sure that folks can afford to take that time off and that they don't have to choose between financial stability and being there for the people that they love. ARP benefits are going to be reimbursed on a progressive scale based off of what you were earning prior to going out on leave. The maximum benefit is tied to the statewide average weekly wage, and currently, when we go live, that number will be $1,423 each week. This is a progressive scale, so the first 50% of the statewide average weekly wage is replaced at a higher rate than benefits that are, or your pay that's earned above that threshold. Now, in order to qualify for partial wage replacements, there's a financial eligibility threshold, which means that you need to have earned at least 5.3% of the statewide average annual wage in the past year in order to be eligible. This is a fairly low bar to clear, but it's $3,900 when we go live in 2026. And that $3,900 could be earned from one or more employers in the base period or the previous 4 completed calendar quarters. So if you are working for an employer and you're only earning $1,000 from that employer, those wages are still subject to paid leave, even if they're below the financial eligibility threshold. But they also count even if you leave that employer. So if you have 4 employers during the base period and you've earned a total of $4,000 and $1,000 from each one, you would still qualify for benefit payments from the program. Now, even if you qualify for benefit payments under the program, there are what are called prohibited payments. So if you're receiving benefits from the unemployment insurance program, workers' compensation, or Social Security disability insurance while you're out on a qualified absence, you're not eligible to receive payments for that same week or that same time period. We will be asking if you're receiving any of these benefit payments during the application process, and we'll also be validating that information using our own administrative data. So that's part 1 of partial benefit or paid leave payments that we make to constituents while they're out on an absence. But another important part of the program is that your job is also protected while you are away. Generally, the employment protections of the program are overseen by the Department of Labor and Industry. But if you take a qualified leave under the program and you've been employed for at least 90 days, you need to be restored to your job or an equivalent position with the same seniority and benefits that you had prior to taking that leave. These job protections kick in 90 days after your date of hire. That's 90 calendar days. Employers are also required to continue to fund health insurance at the same level that they were funding it prior to you going out on leave. And finally, there's provisions in the law that prohibit an employer from retaliating or interfering with an employee who is trying to access benefits with the program. That means you must not interfere with or retaliate against employees if they apply for or use the program. Employers also cannot take the paid leave benefits from employee checks. I will just flag on this one particularly that there is it says generally in both the job protections and the health insurance continuation section. What that's referring to is there is a small exception for workers in the construction industry under a bona fide collective bargaining agreement where these provisions can be waived. But for every other employer in the state, these provisions apply when an employee is taking leave under the program. So what does a leave look like when somebody goes out? Well, first, it can be taken in different leave schedules. A leave can be taken either continuously or intermittently. For those who don't know, continuous leave refers to when an employee takes leave in one big block of time. So they're out from January 1st until February 2nd in one big block of time. However, an employee may also take the leave intermittently, which is instead of taking it in one big block, you take it in smaller blocks over a longer period of time. Both leave schedules are allowable under the paid leave statute. I do want to flag that as an employer, you do have some rights in this portion of the law. First, as every employer can set how big that block is of intermittent leave. So if it works for your business to allow employees to take leave in 15-minute increments, you'd be able to enforce that. You would also be able to tell employees that they could take half of a day or an entire day. The size of the block is completely up to you as an employer. Now, the program's funded. A question that we often get is, well, that sounds great. How is the program funded? Much like private insurance, paid leave is funded through premiums, and those premiums are shared between an employer and an employee contribution. When we go live, starting in January, the premium rate will be 0.88% of wages. That covers both family and medical leave. That 0.88% is applied to wages paid after January 1st through after January 1st up to the Social Security cap of $176,000. The first premiums of the program are due on April 30th of 2026, and that will be based off of wages paid from January 1st to the end of March of that year. So for most employers, the premium rate is 0.88% of wages, but for small employers, it's an even better deal. Small employers pay a reduced premium. The employer portion of that contribution is cut in half, which would make their effective premium rate 0.66% of wages up to the Social Security cap. Of those, the employer can still reduce employee pay by 0.44% of wages. So they can take 0.44% of wages to fund the premium of 0.66. Now, our program defines a small employer as an employer that has 30 or fewer employees and pays an average employee wage of 150% or less of the statewide average. That's about $107,000 when we go live in 2026. Like we said, that reduced premium only applies to the employer portion of the contribution. It does not change the amount that's owed by employees. For these same small employers, we also offer a small employer assistance grants program. This will also be available starting on January 1st of this year, and funding will be available to support small businesses during an employee's absence. Employers will be able to apply for this funding once an employee goes out on leave, and it's up to $3,000 per leave to hire a temporary worker, increase existing workers' pay, or train workers to cover for an employee while they're out on leave. I do want to flag that this is a limited pool of money, so the funding is not guaranteed, but you will need to be a small employer in order to apply. Now, I threw a whole lot of math at you there very quickly. So I do want to flag a resource for folks on the line that both premiums and payments can be calculated on our website. You can use our online calculators to estimate the costs and the payments that will be available under the paid leave program. You can use this to plan for 2026 and compare the program costs and the benefits. One example, for somebody who earns $70,000, they're looking at a weekly premium of less than $6 a week, but while they're out on leave, they'll be able to receive up of $1,500 or $1,059.22 each week. These calculators are available on our website, and you can see the link in the chat. Employers are also able to offer these benefits themselves rather than going through the state plan. By providing an equivalent plan that meets or exceeds the coverage that's offered by the state. This is available online today for employers to apply to offer these benefits themselves rather than going through the state plan. We're often the least expensive and easiest option, but no matter how you decide to bring paid leave to your employees, the process should be easy and intuitive. There's two ways that you can purchase it, or you can use an equivalent plan. The first is using a private insurance carrier. We've worked with the Department of Commerce and carriers across the state to create a list of carrier plans that are available for purchase today in the state. In order to turn that into an equivalent plan, you only need to show us the signed contract by submitting it through the application on our website. You can also fund this through self-insurance. where you would just continue through salary continuation. That process is also available online today. Now, even if you receive an equivalent plan exception, you still have obligations under the law. Those include continue to submitting wage detail every quarter. All the job protection provisions still apply, and employees cannot be charged more than what they would have been paying under the state plan, which means that even if you have an equivalent plan, you cannot charge your employees more than 0.44% of their wages up to the Social Security cap. Last, for this audience, I do want to cover some tax responsibilities for the program. So we're going to talk both about tax treatment of premiums as well as for the payments that we make to the constituent while they're out on a leave. Some important information to know is that the premiums are collected on a post-tax wage basis. Employers, for their required premium, that's the for large employers 0.44, for small employers 0.22%. Those contributions can be deducted as an excise tax. Now, an employer, if they choose to pay more than that required premium, and they choose to pick up part of the employee's portion of that premium, they can deduct that additional contribution as an ordinary and necessary business expense. Now, whatever payments an employer makes as part of a premium payment should be reported on an employee's W-2 in box 14 and labeled as MNPFML. So that's on the premium side of the house. On the payment side of the house, the treatment's a little bit more complex. I'm going to start first with family leave payments because they're fairly straightforward. The payments that we make for family leave, meaning for bonding leave where you welcome a child into your home, caring leave where you're caring for a loved one, or military or safety leave, those payments are not considered wages, and so they do not need to appear on an employee's W-2. Paid leave will issue an employee who takes family leave a 1099 at the end of the year, so we will handle that process for you. Medical leave payments, based off of guidance from the IRS, are treated similar to third-party sick pay. So only a portion of the medical leave payment is considered wages and is also subject to Social Security and Medicare taxes. So for large employers that pay the 0.88% of wages, 50% of medical leave benefits are considered wages. For smaller employers that pay 0.66, 33% of those payments are considered wages. And those amounts need to appear as wages on an employee's W-2. Now, the state's going to be providing employers and employees with information on how tax withholding works in the benefits process as part of an application for benefits. We will also be providing employers with information about payments, including the taxable amount of medical leave payments as part of the Leave Administrator portal. So you will be able to download this information the day that when a benefit payment is processed. You'll be able to download that information so that you can make your portion of the contribution to the IRS in a timely manner. We have some additional information on taxes available on our website, including responsibilities for employers. And we're going to continue to put out more information as well as examples of how this can work in the coming month. So that's what the program looks like at a high level. Let's talk about what you can do today to prepare as an employer for January 1st. When you're thinking about getting ready for January 1st, there's really 3 steps that you need to take. First, you need to set up your accounts with the paid leave program to make sure that you're ready to work with us when an employee requests a leave. Second, you need to notify your employees about the program. We'll talk about those requirements in a bit. And then third, You need to get your business prepared, preparing your workplace by adjusting policies and making decisions to make sure paid leave works the way that you want it to work in your business. So let's go through those really quick. Step one, you're going to need two separate accounts, an employer account and an administrator account. The employer account is the one that you already have in the unemployment insurance system program system. But you'll also need to create an administrator account for the paid leave program. The employer account, this was something that we worked actually with NPRC early on. And in order to make things easier for employers, some feedback that we received early on was we heard that employers were concerned about redundant reporting requirements across multiple state programs. Hearing that, we worked with the unemployment insurance program to create a process where for the vast majority of employers in the state, they had nothing that they needed to do in order to be in compliance with the first major milestone of completing wage detail reporting with the state. So the way that this works is that your existing UI account was converted into a joint paid leave UI account. So when you complete your regular UI wage detail, that information is shared directly with the paid leave division in order to meet your reporting requirements for our program as well. For folks that don't have an unemployment insurance account, but are required to participate in the paid leave program, we also set up the ability to create a paid leave only account. With that account, you will only submit wage detail to the paid leave division. If you need help setting up your account or just verifying the information in it, the UI Customer Service Center is available for assistance and would be the right place to go for questions related to setting up a UI or an employer account. Another important feature in this account is that this is where you're going to designate a paid leave administrator. We want to flag this as a step that you can take today in order to be ready for January 1st, 2026. That leave administrator will have access to the paid leave portal. This is an account that we built with HR professionals across the state, and it's there so that we're creating transparency when an employee requests an absence. When you have access to the leave administrator account, you'll be able to review applications that are submitted by your employees, see determinations. It's also where you would submit an equivalent plan substitution request if you choose to go that route. We've really worked with HR professionals across the state to make this as easy. We're trying to make this experience as easy as we can so that you can support your employees during these important moments in their lives. So that's the first step. If you set up both the employer account and the administrator account, you are almost there. The next major thing that you need to think about is notifying your employees about the program. Our program has two notification requirements. First, all workplaces need to display a workforce poster. And second, individual employees need to be notified directly about the program in advance of premiums going live. So with the workplace poster, this must be displayed in English and any language spoken by 5 or more employees or independent contractors. We currently have this poster available in English on our website, and we'll include that link in the chat. And we'll have more languages available very soon. We're also going to be publishing a version of this poster for employers with an equivalent plan. So this will be available today if you need to put this up in your workplace to start notifying your employees. Next, you'll need to notify your individual employees about the program, either 30 days from the date of hire or 30 days before premium collection begins. That means for January 1st, you need to notify your employees about the program by December 1st, 2025. Now, this notice has to be provided to employees in either their native or preferred language, and paid leave will provide sample notifications for employers in multiple languages to support them through this process. something to note is that these notifications need to be documented. So you need to be able to show that an employee has received this notice. Best practice would suggest getting a signature on the notification so that when you're asked in a situation where an employee says that they weren't notified, we will come and ask for proof that they were. So having this documented and in their employee file is an important step towards compliance with the law. And not only is it an important step towards compliance, it's actually the last step towards compliance. If you do those first two actions of making sure that you have a paid leave account and that you've notified your workforce, you are going to be in compliance for January 1st. So it's a surmountable task to get there for January 1st. But there are other important decisions that you can make today that can make paid leave work really well for your workforce. So on that note, the third step for preparing for paid leave while we're in bonus time is making important decisions for your workforce. These decisions are going to impact how paid leave will work for your employees, how it will work with other benefits that you offer, and it could encourage you to update some existing workplace policies. So let's talk about how it's going to impact how paid leave will work for your employees. So we went through the premium rate earlier in the presentation, but one thing we didn't mention is that employers can choose to pay more than the employer's minimum contribution. So if the contribution is 0.88% of wages split equally between employer and employee, there's nothing that keeps an employer from offering more than that 0.44%. They could choose to pick up the whole contribution for some or all of their employees. This is something that we've seen in other paid leave states as a perk that some employers will offer. You need to also get set up with your payroll system or another method to collect the premiums when the program goes live. Additionally, this is the time to think about an equivalent plan. If you choose to go with the equivalent plan option to offer these benefits yourself instead of going to the state plan, you could use the tools on our website to prepare the costs and benefits of each option and decide if the state plan or an equivalent plan is the best path for you. And if you choose to go through an equivalent plan, you'll already have your leave administrator account set up, and it's a very straightforward application. Next, how you can make decisions about how paid leave will work with other benefits that you offer. We know that paid leave fits into a bigger picture, and employers may be already offering payments to employees when they have a similar qualifying condition. When we think about how those payments are going to be working with paid leave, we typically think of them in two different buckets, supplemental payments or substitute payments. A supplemental payment is a payment that's made to make up the difference between partial and full wage replacement. And you can think of it as topping off paid leave payments. An employer has the option to decide whether or not they are going to offer supplemental benefits on any application for leave. And we'll ask you during each application for benefits whether or not you're offering supplemental benefits. If you do so, we'll provide information on how much you can pay in order to not exceed the employee's regular wages, and we'll also inform you every time that a payment is made by the division. Now, that decision to make a supplemental payment is up to the employer. If an employer chooses not to offer supplemental payments, employees can still take their paid time off or other personal time, but it will be in lieu of receiving a payment from the division. So we wouldn't pay during those weeks, but the employer could pay the benefit instead. So here's a few scenarios to kind of ground us in this topic. A few questions that we receive fairly often are, we currently offer new parents 6 weeks of full wage replacement when they welcome a new child. Can we still do that? And the answer is yes, you can, and it might come at a lower cost to your business. So you could, instead of offering paying the full 6 weeks of full wage replacement, you could transition those payments into a supplemental benefit payment, where the state covers the first portion of that person's salary, and you would be able to pay the remainder. We want to offer our senior managers full wage replacement, but maybe we don't want to offer it to all of our staff. Are we able to do that? Yes. As an employer, you also get to decide who is eligible for supplemental payments versus who is required to take PTO as in lieu of receiving a payment from the division. Third, can we require employees to use their PTO so that they get full wage replacement? Now, this one's a little bit trickier because no, unlike programs like FMLA, there's a prohibition in our law from employers requiring employees to use PTO as part of an absence. You can offer it, and if you offer it, the employee then can choose whether or not they want to use their PTO in this way. And what happens if, when I have an employee out, they take a full day of PTO during the leave? So they're taking paid leave benefits for 4 days out of the week, but then they want a full day of PTO on Fridays. What happens? So in this case, this would not be a supplemental payment. This would be a substitution payment. PTO would replace the paid leave payment for that day. We wouldn't make a payment for that Friday, but we would pay for the other 4 days. So that's how it kind of works with your other benefits, but we know not all benefits are paid. In fact, there are programs like FMLA that can run concurrent with paid leave benefits. There are some other workforce policies that you can look to update. First, leave notification policies. As part of our law, employers are able to enforce their usual and customary leave notice requirements unless the reason for an employee's leave prevents this, which means that you can require employees to call a number, to email a person, to have a conversation with their manager prior to coming to the division to apply for leave. As we mentioned earlier, in intermittent leave, employers also have the ability to decide how big of a block of time employees are allowed to use each time that they take intermittent leave, all the way down to 1 minute of leave up to an entire day. You can also decide if the law requires that employers offer 480 hours of intermittent leave each year. Employers could choose to offer more than that during the course of a year, or they can require the leave to be taken continuously. It's another choice for an employer to make. So those are some policies that you can update in order to get your workforce prepared. So let's take a preview into what it's going to look like when we go live in 2026. So the most important thing today is to think through getting your leave administrator designated, because on January 1st, this is going to be the person that keeps your organization in the loop when your employees request leave. This paid leave administrator is somebody who's going to be able to manage your account with the division, coordinate paid leave with other benefits, request equivalent plans, as well as review applications that are submitted to the division by your employees. And if you're a small business, they'll also be able to apply for that small employer assistance funding. One more thing is this will also have access to that tax information that we mentioned earlier. The employer, the employee, and the paid leave division all play a role in an application. We do require that employees start their leave with their employer, and we do ask them about when and how they notify their employer. When an employee completes an application, we also send the leave administrator a request to review where they're provided with some information that was provided to the division as part of that application. We then adjudicate that application using information from the employee, the employer, the healthcare provider, and our own administrative data to reach a decision. And when we reach a decision, both the employee and the paid leave administrator are notified of that determination. Sorry, my computer has. Yep. So here is an example of what this is going to look like on January 1st. This is what a leave administrator will see when an application is submitted to the division. You can see that we're including information like the date that the employer was notified and how they were notified, and whether or not that was equal or whether or not that was correct, or if you want to tell us that something was wrong. We break out the leave periods, make sure that we're on the same page of when the person is going to be out on leave. And we also ask about employer paid benefits like paid time off during the leave. And as you can see, every leave we will also ask about whether or not you're paying supplemental benefits as part of that application. We'll also, in the future, ask for information if there's a leave that an employee has taken that should reduce the amount of leave available to the division that didn't result from an application directly with paid leave. All of this information is important, and it's something that's going to allow a leave administrator to help make this work for your business. Not all benefits provided by an employer are paid, and an employee may be eligible for more than one type of leave or more than job protections from more than one program when they qualify for paid leave. For events that qualify under both FMLA or the Pregnancy and Parental Leave Program, both are laws that provide unpaid job protected leave for conditions that would also qualify under paid leave. If you have an employee that is taking leave under both programs, they are taking leave for an event that would qualify under both programs, you're able to run those concurrent with one another. So you're able to tell us that an employee took FMLA, or you're able to run your FMLA allotment at the same time as your paid leave allotment. We'll also allow the ability for employers to tell us whether an employee has taken other job protected leave for a reason that would have qualified under paid leave once the program starts. In those cases, the employer will need to provide documentation showing that the employee knowingly used that time instead of applying to the division. This can result in a few things. So this leave administrator will have the ability to coordinate time for an employee while they're out. So for an example here, we have an employee that applies during week 3 of their leave, but they've been out for the previous 2 weeks under FMLA. Because the 2 weeks of PTO and they were being paid via PTO during that time, because the employer designated those 2 weeks as FMLA, the paid leave start date would be the same date as the FMLA date. So we would only pay 10 weeks in this situation. The employee, because they use 2 weeks of PTO before beginning paid leave, will only pay for those remaining 10 weeks, and that will also end their job protections at the end of week 12. So with that, I do want to say thank you again to the NPRC for continued partnership throughout the implementation effort. We've been taking a ton of feedback from employers and employees across the state. We've actually done over 250 engagement sessions with a variety of stakeholders answering questions and gathering input about the program. And we're still conducting user research on a variety of things to make this program work for the state of Minnesota. We've learned a lot from employers, and based off of those lessons, it's made a tangible difference in the way the program works. Employers are the reason why we launched Wage Detail in a system that they already know. They supported us in drafting rules to support the implementation of the statute based off of, their feedback. We partnered with the Department of Commerce to create an equivalent plans process and a viable market for employers that choose to offer the benefits themselves. There's a whole lot of ways to stay engaged with us. Your partnership and expertise are so important in making the program work. First resource is making sure to check out our website. We have an employer guide of 3 steps that you need to take to be ready for paid leave, as well as a ton of frequently asked questions that are informed from sessions just like this. You can use those premium and benefit calculators on our website if you want to look at the costs and the potential benefit of the program. And we also have instructions there to help you set up your accounts for paid leave. You can sign up to receive our newsletter, and you can also send us questions, either via email or through our contact center. Our contact center is available from 9 a.m. to 4 p.m. Monday through Friday, and that number is 651-556-7777. With that, I just want to thank you all for your time today, and then I think we have some time for QA. So Corinne, I'm going to turn it back to you.
Yes, thank you, Greg, so much. We'll transition over to our Q&A session. Thanks so much to MPRC and for all of you who submitted these great questions today. We have about 40 minutes left and we'll answer as many as we can get through. But remember, if we don't get to your question or if you think of a pressing question just after the presentation is over, you can call our contact center. Greg just shared the information for the phone, and you can also go to our online form. So the first question, Greg, is can employers opt out, choose not to participate in the paid leave program? And what about individual employees?
Great. Yeah, and we hear this question a lot. So the answer is no. And employers cannot opt out of paid leave. There's no individual opt-out available under the program. However, employers can choose to offer an equivalent plan instead of participating in the state program. They can apply for an equivalent plan exemption or a plan that meets or exceeds the coverage offered by the state. Employers approved for an equivalent plan will not need to pay benefits or premiums to the state, but will have other obligations, including wage detail reports each quarter and complying with the requirements to notify their employees about coverage. But there is no individual way to not participate in the program, either as an employer or an employee.
Great, thanks. Do employers report wages when they're earned or when they are paid?
Great. Wages are reported the quarter they are paid, not the quarter that they are earned. So it should only be on paychecks received after January 1st.
Will an employer's premium rate increase if employees use paid leave?
Great. No, unlike programs that are experience rated like unemployment insurance, rates are not tied to utilization here. So regardless of if your employees use the program, your rate will remain the same as everyone else in the state.
Greg, you talked about this in the presentation, but how will paid leave work with PTO, sick time, or vacation time?
Great. Yeah, so there's really two ways. It can either work as a supplemental benefit or as a substitute payment. If an employer chooses to offer supplemental benefits, then their employees could choose to use their paid time off, sick time, vacation time as a top off to their benefit so that they could get full wage replacement while they're out of work. However, if an employer chooses not to offer supplemental benefits, then the payment could be used in lieu of receiving a payment from the division. So the employee would still get full wage replacement, but that wage replacement would come entirely from the employer instead of coming from the state.
Okay, great. And how will paid leave work with short-term disability plans?
Great. So short-term disability is kind of an odd duck when it comes to the supplemental benefit payments versus the substitute payments framing. By default, it is always a supplemental payment. So while by statute, the paid leave division is the first payer in short-term disability arrangements. So the paid leave benefit can reduce the disability payment made by that carrier, but the payment made by that carrier will not reduce the benefit payment paid by the state. So you'll see some shifts here. Short-term disability providers may start offering in excess plans where they would only pay that top off between partial and full wage replacement. But it's a good note to make sure that you are looking at how you are covered for short-term disability, because our payment could be used as a deduction in the private carrier's plan.
Great. The next question is, do employees have to notify their employer about their intention to take leave?
Yes, in all situations, yes. Employees need to notify their employers of the request to take leave. This is going to be enforced as part of the application process. As we saw, there is going to be a screen that asks employees how and when they notified their employer, and we will share that information with the employer as well. Like we said, an employer has the ability to enforce their usual and customary absence processes. So an employee can be required to notify a specific person within your business prior to applying to the division, and we will enforce them.
Okay, this is a question we get a lot. What happens if you have a baby in late 2025 before paid leave goes into effect in 2026?
Yeah, bonding leave. So if you welcomed a new child into your home anytime within 2025, bonding leave can be taken within 12 months of the date that you welcome that child. So parents that welcomed a child in 2025 may be eligible for paid leave in 2026 up to the 1 year either birth date or date that the child arrived in your home. Even if the employee has used protected leave during 2025, our program goes live on January 1st, 2026, and leaves taken before that date cannot be used to reduce the amount of leave that somebody would have access to on January 1st. So parents that welcomed a child in 2025 may be eligible for leave in 2026.
Great, thanks. To clarify this, are S Corp owners covered by paid leave?
So we get this one a lot. It's probably one of our most frequent questions about coverage. And the answer is that there's no explicit exclusion for S Corp owners or operators under the paid leave law. So those operators who are required to pay themselves a reasonable salary, those wages that they're paying themselves in salary are subject to premiums and can be used to meet the financial eligibility threshold. So if they need to take a leave, they could qualify for benefit payments.
Great. Okay, so will paid leave be making a determination on whether the employer qualifies for this small employer rate and informing those employers? If so, will the paid leave division notify TPAs?
Yeah, so the way that the small employer determination process is going to work, it's an annual calculation made each October, or based off of the wages from September to September. So the wage detail report that's going to determine whether or not business is a small employer or a large employer is actually due on Halloween, so October 31st of this year. When that is filed, we will follow up with a letter to employers that tells them their status as either a small employer or a large employer.
That's great. Okay, so can paid leave clarify the maximum employee weekly contribution rate of $14.90? Is this the maximum amount an employer is allowed to withhold from an employee per week? How is an employer supposed to withhold for high earning individuals?
Yeah, this question's coming from a little bit of a misunderstanding of something we published on our website. So we had a table on our calculator that said that the maximum contribution for an employee was $14.90. What we were really trying to get at is that is if you take the 176,000 and divide it by 52 times the contribution rate. It's meant as a average amount that somebody could pay during the course of a year, but there's no weekly maximum contribution. It should be 0.88% of wages up until somebody hits $176,000, and only at that point should you stop withholding for premium payments.
Got it. Okay, thanks. So regarding premium for people who earn the minimum wage, the premium deductions cannot cause an employee to make less than the required minimum wage under the paid leave law. Does this mean that the employer must cover the total contribution for employees who make minimum wage? And I'll note the person who asked this noted that most minimum wage regulations are about gross hourly earnings rather than net pay.
Okay. So an employer must pay at least, in most cases, an employer must pay at least half of the premiums for each employee. Additionally, there is a provision in the law that provides that an employer cannot deduct employee premiums from an employee's wages in an amount that would cause the employee to make less than the minimum wage required by other applicable laws. It's the employer's responsibility to comply with this requirement and may require the employer to cover greater than 50% of the premium in some cases. With that noted, DLI has told us that they intend to use the paid leave definition of wages. So in that case, tips would be included in taxable wages.
Should employers report anything in the W-2 for premiums deducted from employees?
So we're requesting that employers put the amount of employee contributions and the amount of employer pickup contributions in box 14 of the W-2. The label should be MNPFML, and if you plan to split out medical and family benefits, you can add each amount and include MNPML and MNPFL respectively.
The next question is, when will the EFT specifications be available for the paid leave payments? Or when will paid leave share the tax payment instructions?
So we are continuously putting out a guidance on how this is going to work with tax withholding for employers when an employee goes out on leave. Our plan is to generate a CSV file that will include the net payment amount, taxable amount, the Social Security wages, and Medicare withholding. And that will be available in the Leave Administrator portal. We'll have much more detail on this over the next month, where we're going to continue to fill out that page. We do have a handout on how taxes are going to work with the paid leave program. But for specific EFT specifications, those are going to be coming in the next month or so.
Great, we'll put that tax information in the chat. Will private plan employers who are SUI exempt need to report wages in the portal? And would they designate the insurance provider as the TPA?
So if an employer are unemployment exempt and have an approved equivalent plan, they will need to report wage detail reports to the state. Even so, in that case, you would need to create what's called a paid leave only account that would only share wage information with the paid leave division instead of sharing information with both UI and paid leave. You can do that by going to uimn.org and going through the registration flow just like everyone else, and that application should pop up. But if you need help, the UI Contact Center is also available to support you.
Great. What is the one thing that TPA should be telling their clients to prepare for January 1st?
I think the big thing right now is that you should be telling your clients to designate a leave administrator. That role is so key to participating in the program, and it's really going to make the program work for employers and employees alike. So if there's one thing I could be telling TPAs to do right now, it's to tell their clients that they should really work towards designating a leave administrator as soon as they can.
Thank you. Okay, great. So the next couple of questions are going back to the localization tests that you talked about earlier and premium payments. Sure. Okay, if an employee works less than 50% of the time in Minnesota, does the employer and the employee not have to contribute to the premium?
That's correct. Yeah. So if your work is localized in a different jurisdiction, so when we say less than 50%, I'm assuming that you're spending 50% or more of your time in a different state. If that's true and you're localized to a different state, then you do not need to have your wages reported, you don't need to pay premiums, and you're not eligible for benefits.
This is a good question. If an employee lives in Wisconsin but works in Minnesota 60% of the time, is the paid leave benefit only based on the wage they earned in Minnesota and not the wages they earned from working from home in Wisconsin?
Okay, yeah, that's a good clarification. Yeah, so when we say that your work is localized in Minnesota, so if you're spending 50% of your time in the state of Minnesota, all of your wages, regardless of where they are earned, are subject to paid leave. So if you spend 60% of your time in Minnesota, it's not 60% of your wages, it's 100% of your wages are subject to paid leave.
This question is about the small employer designation. As a third-party administrator, what's the easiest way to identify if any of our employers will get the reduced small employer rates? Can there be an export feature on the portal that we can use, or do we rely on looking up the accounts one by one, or just wait until the employer notifies us?
Yeah, so like I said, we're going to be notifying folks in the November timeframe after that last quarterly report is submitted. But you know, it is simple math. If you're completing tax filings on behalf of your clients, it really comes down to, is there any quarter in which the employer has more than 30 folks being reported on a single report, and then averaging out what their average wage is, just taking, and that's on gross pay for all of their employees. So it's a two-part math equation, but the first one's a pretty easy one. Just, are there any quarters with more than 30 employees? If so, then the person does not qualify as a small employer. If yes, then you can calculate the seasonal or the average employee wage by taking the gross wages and just dividing by the number of employees. And if it's below that $107,000 number, then they would be a small employer under the program.
Okay, that's really helpful. The next question is on the payment eligibility or the threshold. So for casual employees that have not met the income threshold, how will payroll specialists know when to start deducting the employee's payroll portion?
Okay, yeah, so this is an area that I think there can be some confusion about. There's an earnings threshold to be eligible for payments from the state. However, all wages, regardless, are subject to premiums under the program. So there isn't like a magic number where if you've earned $1,001, suddenly you're subject to paid leave premiums. You're subject from $1. So even in that situation where you have an employee that's only going to be working and earning $1,000 from you, those wages are still subject to paid leave and should be reported. And then for that individual, those wages plus any other wages that they earn from other employers do count towards their financial eligibility.
The next question is about the healthcare continuation while someone's out on leave. Are employees required to continue their portion of the insurance premiums when they're on leave? What if they don't keep up with those payments?
Yeah, great question. So that is something that we hear quite a bit, and there are different strategies for being able to collect this the health insurance contribution from employees. We've heard from employers that will require an employee to write a check for the amount of the healthcare premiums while they're out on leave. We've heard others that are planning to offer supplemental benefits and then taking the healthcare premium as a deduction in the top off that they would be paying for their employees. And we've heard from employers that plan, once they are notified of somebody taking paid leave, they work with the employee to get consent to pre-fund those health insurance premiums before the employee goes out on leave. It is a requirement under the statute that the employee does owe the employer the employee portion of the contribution.
Okay, this would be a quick one. Where is the statewide average weekly wage published?
Well, it's calculated each year by LMI, but it's published, if you Google just SAWW, Minnesota SAWW, you'll end up on the workers' compensation page, and that's I think that is the first place that it's updated in state communications. So that's a good place to look.
For private plans, okay, so if an employer is who is exempt from unemployment insurance taxes goes with a private plan for both family and medical leave, do you expect the employer, the private plan carrier, or who should file with the state at all? How would that work?
Okay. Yeah, well, even if you have, so I'm going to restate the case and make sure I've got this. So it's an employer who's not required to participate in unemployment insurance that's decided to offer paid leave through a private plan instead of going through the state plan. So who files or who has to do what? Okay.
Right.
So even if you have an equivalent plan, you still have a filing obligation with the state each quarter. You still need to report your wages through a paid leave only account. Now that can be done by the employer themselves or through a third-party administrator. We don't really take a position on who needs to be doing that wage detail filing, but it is required on a quarterly basis. Also, in order to offer a equivalent plan, you do need to apply to the division so that we can review it to ensure that it meets or exceeds what's offered under the state plan. In order to do that, you'll need to set up a paid leave only account with the UI division and designate a leave administrator through that system. Then that leave administrator would be able to apply for your equivalent plan substitution. Even if you're offering benefits that you believe meet or exceed the requirements under the law, you still need to submit an application in order for it to be approved. Otherwise, those wages are subject to premiums.
Great. I have a couple more questions about leave admin accounts. Is the paid leave admin login necessary for filing taxes or payments, or is it just necessary for managing employee claims and payouts?
That's a good way of thinking about it, that the employer account through the UI system is really about wage detail reporting and premium payments, whereas the leave administrator account is more of an HR function. So it's about managing absences when somebody is out on leave. The only thing that I will flag here is that the information that you need in order to submit your the employer portion of Social Security and Medicaid, where that applies, that information will be shown in the leave administrator portal. So you will need to, it will be downloadable, but it is something that you will need a leave administrator account for as well.
So I think you clarified this, but I want to do it one more time. If you already have an existing UI account for all your employees, do you need to set up another employer account, leave administrator account?
Great. If you have an existing UI account today, so all of your employees are covered under the unemployment insurance program, for the purposes of wage detail and premiums, you don't need to create a new account for that purpose. However, you will need to designate a leave administrator in order to request an equivalent plan exemption or receive information about an application that's been submitted to the division. So yes, you will need to set up a leave administrator account separate, even if you already have your UI account.
Greg, can there be more than one leave administrator?
Yeah, you can have as many leave administrators as you want. Whatever works for your business. You can, it can be one person, or in larger complex organizations, you can have more than one person. If you want to back up for the person, they both can have the same access. It's as simple as creating a role. It's within the UI system, you get into account roles, and then you can add as many folks there as you want.
Great. So I have a couple of questions here on premiums. What are the incentives to employers to cover the entire premium cost?
Okay, incentives. So I think the first one is that if you do the employer pickup, so if you do pick up the employee portion of the contribution, it is tax deductible. It's an ordinary and required business expense. But what we've seen in other states is that this is a benefit that some employers will choose to offer to compete for employees. So there are job descriptions in paid leave states that mention that they pay the whole contribution. So it's an employee perk, but it's also something that is tax deductible.
So since this decision is being made now, another question is how often can employers change the amount they pick up on behalf of their employees? Can it be done multiple times in a year?
So the leading requirement here would be notification of your employees. From the paid leave division's viewpoint, we'll only really see the employers responsible for contributing the whole amount through the UI system. They can deduct a portion of it from employee wages, but if you're going to deduct from employee wages, you are required to notify your employees prior to doing that. I think it's a month before you're able to change. But yeah, there's nothing that locks you in to one way or the other.
Great. How frequently do premiums need to be paid? Is it submitted quarterly or every pay period?
So it is quarterly to the division, but you should be deducting it from employee pay starting on January 1st on whatever your regular pay cycle is. So if you get paid weekly, the employee's deduction should come out of their check on a weekly basis. But then at the end of the quarter, it's actually on April 30th of next year, all of the contributions from the employee and the employer portion need to be submitted through the employer account.
Okay, the next question kind of asks to elaborate a little bit more about intermittent leave. Are applications required for intermittent leave for each leave, or how does that work when someone is taking intermittent leave?
Yeah, great question. So this is similar to how it works under FMLA, which is that an employee will request the absence for the entire period of time that they're going to be out, but that will include a frequency and a schedule for when they're going to be out. Intermittent leave really has two different flavors of it being either a planned scheduled intermittent leave where the absences are known and predictable versus episodic where they're less predictable over time. In that situation, in both situations, the employee will apply up front for the frequency of time that they're going to be out each week. And then they'll be required to submit a report in order to generate payment. So there's no new application in order to get approved for the intermittent leave, but we will get a report each week and we'll share that with the employer with 2 business days notice before we start generating payments. So it's not a new application, but employers will be informed when we're starting to generate a payment for an intermittent leave case.
Okay, the next question is also about how employers will be informed. This is about supplemental benefits. So how quickly will employers find out about the state's payment amounts to employees to ensure that employers top off the appropriate amount to employees? So how is the state recommending that employers ensure that there's accurate top off amounts that don't exceed 100% of regular earnings?
Yeah, great. Yeah, so we will include the benefit amount that we're paying each in the approval letter for the employer and the employee. So you'll be able to see how much we're paying each week just in the approval notice itself. So you'll know that before any payments generated. But then we'll also provide a CSV form of payments that we make to the employee as well. On the day that it's generated, we'll also bring that into the employer portal.
Great. The next question is for small employers. Does the 30 employee threshold mean only Minnesota employees or all employees?
It's a great question. Yeah, it does refer to your Minnesota workforce. So it's the 30 or fewer employees in Minnesota with an average wage of less than 150% of the statewide.
Okay, thanks for clarifying that. How does paid leave coordinate with workman's comp payments?
Workers' comp payments, generally speaking, it is a prohibited payment. So if you're receiving workers' compensation during the course of an absence, we will not generate a payment for those weeks, assuming it's for the same qualifying condition.
So on the private plans or the equivalent plans, are employers able to switch between the state plan and private plans each year? What is the maximum length that an employer has to stay with one program?
So switching between a private plan and the state plan is totally possible. You can choose to start with the state, and then you will be able to go to a private plan almost at any time, but it will be in effect the quarter after you apply. So if you ask for an equivalent plan in, say, February of next year, that will be effective until April of that same year. You can switch between the two very easily. You can also come back to the state plan very easily, but in the case that you leave an equivalent plan and come back to the state plan, you are locked into the state plan for a defined amount of time, which I'm not getting in my head right now, but I think it's 3 years that you're stuck in the state plan from there.
Great. And so, Greg, you mentioned in the presentation when talking about employee notification that it's best practices for employers to ask employees to sign the notification notice. What if an employee refuses to sign the notice to make sure they're aware of paid leave?
Great. Yeah. So on the employee notice portion, a physical signature is good practice. We've also seen this implemented in ways where an employer has updated it into their payroll system so that when an employee reports their time, they get a notification that they have to acknowledge that they've seen or been notified about the program. But regardless of how you do this, you need to be able to show that you notified your employees. Now, the most straightforward way would be having them sign something that says that I've been notified of the program. If an employee refuses to do so, there is a provision in our law that allows an employer to show how they notified their employees without that signature. So based off of the preponderance of like showing us that you've notified that as part of your onboarding process, you have people have the opportunity to sign this form. And if they refuse, then you can make a note that they refuse to do so.
Great. Now, the next question is similar, but it's notifying your employer of your need to take leave. So if the employee doesn't notify the employer of their need to take leave, can the employer deny the paid leave and charge an absence?
So an employee needs to start with their employer where it's practical, where it's reasonable for it to happen. In cases where an employee doesn't notify their employer, our first goal is to mitigate it. We do ask in the application how the employee was notified or how the employer was notified. And then we also offer whether or not the employer wants to pursue further action on this. It could result in a denial if the application isn't submitted after notifying the employer.
The next question is on private plans. Is Minnesota keeping track of private plan employers in their system for those employers who are only participating in one component of the program?
Yeah. Yeah, we are. So like we said, in order to qualify for an equivalent plan, you do need to apply to the division. We didn't mention, but you can apply for just family leave or just medical leave, family leave or medical leave or both. In all of those cases, you do need to apply directly to the state in order to be approved to offer those benefits. If you don't apply to the state and are approved, then you will be subject to the premium starting on January 1st.
Great. Can an employer require staff to use their vacation, sick, personal leave before they can go to the paid leave program?
No, an employer cannot require an employee to use their personal time as part of going out on leave. They can offer it as a supplemental benefit. They could, if the employee has paid time off, the employee can choose to use that time off, but our statute prohibits the employer from requiring the employee to use the paid time off.
Great. This is a great question about multiple jobs. If an employee has 2 jobs with 2 employers, how will an employer know to what kind of top up is needed? So employer A doesn't know what employer B is doing.
Great. So if you have multiple employers, you're going to need to submit multiple applications out of the gate. and will only share the information about the absence with the employer from whom you are taking leave. And that top off will be based off of the wages paid by that employer. So we'll provide that employer with information on how much they're able to top off that employee.
Great. This question is on the premium rate, and we probably only have time for one or two more. But do we know yet if the rate will change in 2027, or is it set at 0.88 for a certain number of years at this point?
By statute, we're required to do an actuarial study each year based off of utilization of the program. When the initial premium rate was set, it was based off of experiences in other states as well as in private programs that are similar to paid leave in order to estimate the overall cost of the program. We will conduct another actuarial study this year, or during the first year of operations, in order to set the rate. But the way the actuarial study is structured is to try to create as much rate stability as possible over multiple years. So the goal, or in setting the rate at 0.88%, is that it stays consistent, but that's subject to the findings of the actuarial study.
Okay, and the last question is great for this crowd. It's about leave admin accounts and third-party access. So how is online access for leave admin's accounts granted to payroll service providers like ADP, Paychex, or Paylocity?
It's as simple as going into the existing UI account. So your client would need to go into the UI account and designate a person to be their leave administrator. So it's a really straightforward process. If you log into the UI system, you can designate a person, including a TPA, as your leave administrator if you choose to do so.
Great, thanks, Greg. Well, it's almost 2:30. I want to be respectful of everyone's time. I'll start wrapping up by asking you for feedback on today's webinar. We'll put up a QR code to a short survey, and we'll also put a link in the chat under the feature tab. The feedback survey only takes 1 to 2 minutes, and it'll really help us understand what worked well here and what could be improved. As I mentioned, if we didn't get to your question today, please visit the website. We can check our FAQ pages for employers and employees. And as always, our contact center is here and ready to help you with any and all questions. Just fill out the form on the website or call 651-556-7777. As a final reminder, the slides from today's webinar will be posted on our website as soon as I've gone through an accessibility review. Okay, we'll end it here. Thanks to everyone who joined us today, and have a great rest of your day. Bye.